Inflation continues to rage higher while economic growth slows dramatically and public ire spikes. What do these growing pressures mean for the future?
And so when we look at what's happened in Kazakhstan, or we look at what's happening as we speak up north in Canada with the trucker revolt over the vaccine mandate, those are all sort of relief valves, pressure releases of an economy and a supply chain and a stock market that we think is at a very precarious potential tipping point.
Welcome to Wealthion. I'm Adam Taggart, founder of Wealthion, welcoming you back for another week of making sense of money and the markets so that you can make better informed decisions about building your wealth. During times like now when the status quo stops thriving, it's helpful to look at the situation through fresh eyes, ones that may see the problems more clearly and perhaps better recognize potential solutions. In May of last year, Doomberg exploded onto the financial media scene, offering insightful and often scathing analysis of the major macro challenges our economy faces. Staffed by an anonymous team of analysts who advise CEOs and family offices, Doomberg is perhaps the most highly regarded new entrant to the financial media world right now. We're extremely lucky a member of the team has agreed to sit down with us and let us peer into their crystal ball to see what lies ahead. Doomberg, thank you so much for joining us today.
Well, Adam, it's a real honor to be on your show. And I must say that is perhaps the most humbling introduction to any podcast appearance we've had. We really appreciate the kind words that you just articulated. And hopefully we'll live up to that live up to that description on a go forward basis. But really amazed to see the growth of Wealthion and the team, the work that your team has done in creating this great platform, and a true honor to be a guest on it. Having perused the prior guests, it's quite the bar for us to jump over to be a member of a guest on your podcast.
Yeah. Well, thank you. Right back at you. It's a mutual appreciation society here. And don't worry too much about those past vaunted guests on this channel. My suspicion is after this interview, you are going to jump to the top of the list of a number of viewers' favorites. Let's jump right in, though, real quick. Number of questions to ask you, but just very quick for folks that may be unfamiliar with the Doomberg brand. Can you just give us a quick grounding in its mission and the people running it?
Yeah, so at its core, the Doomberg brand exists to teach non-finance topics to the financial professionals on Wall Street and in the global finance community. And we are a team of scientists slash industrial executives who have since retired and started their own firm. And one of the things that we do well is we distill complex topics into prose that is accessible by non-technical readers. And we do believe that more and more of the financial decision-making process involves at least a good understanding of the technical evolutions that are required to sort of meet the commitments that various companies might be making, or to understand the macro picture through a technology lens. And so in our consulting practice, as you described, one of the big attributes and one of the descriptors that our clients would say characterizes our work is we can take complexity and make it accessible in a way that those who are writing checks have a better idea about the technical risks and opportunities that are sort of underpinning the investment. And so we've carved out that niche in our private lives, and we've been able to parlay that into what a newsletter, doomberg.substack.com, that has succeeded beyond our wildest imaginations when we started. But it is really the work of our life. It's a really fun project. As we were talking before we came on the air, I think we're 85 or 86 pieces into this, and we've not yet had one feel like work, which is a really great sign that this is what we were meant to do. And we do think that the success of Doomberg is at least in part how it becomes apparent to our readers just how much fun we're having doing this, and just how this is truly our passion and truly the work of our life. And it is an incredible blessing after so many years of experimentation and working in industry versus starting your own firm and going through COVID and nearly losing our firm, to finally find the thing that we were meant to do, and then to start doing it, and then to experience the amazing positive response from our readers for having done it, it is truly a blessing, one that we wake up every morning and we count our blessings, and it's really just a thrill. And that the thought that we would be sitting here being interviewed by you, so many months into having started this, it's just inconceivable. We're truly humbled, truly grateful, and it truly is the work of our life.
Well, that's just wonderful to hear. And, the fun part definitely comes through in reading your work and following you, especially on social media. But also the expertise really clearly comes through too. You guys are extremely rigorous in your work and you're great communicators. And I got to say, I definitely feel a brotherhood with your team there at Doomberg, because Doomberg and Wealthion started in the same month. They launched in the same month. They both had a fair amount of success so far, which is great. And I think we do sort of pursue a similar mission, just slightly through different mediums. So yours is more written, ours is more video. But we're really all about bringing a brain trust of expertise to the average investor and helping distill it for them in a way where they don't get lost in all the jargon. They can actually see the forest through the trees, hopefully, in a way, because we're articulating it in a way that they can digest and understand. So we'll get more into how people can learn more about you and your work in just a bit, but let's dive into the meat here. I'm going to start with the question I ask all my experts at the beginning here. It's a pretty big macro question. Tackle it any way you like. But what is your current assessment of today's global economy and financial markets?
So we would characterize today's global economy in one word as precarious. We have a lot of issues in the supply chain, as I'm sure many of your listeners would be familiar with now, but we have been highlighting those literally from the beginning of Doomberg. The unique aspect of the Doomberg team is our ready access to dozens of C-suite executives in heavy industry. And they have been ringing the bell on inflation and supply chain crisis since before we started and posted our first post all the way back in May, or very early May of 2021. Doomberg is unique in the sense that as executives with substantial experience in sort of Fortune 100 type companies, we are free to write about it because we no longer work in that space. And very few executives with the expertise that we have from the bottom up in these types of supply chains would be willing or are able to articulate what's truly going on in real time. And that's the real service of what Doomberg tries to provide to the financial community, which is this: forget about the spreadsheets, forget about the macroeconomics. Let's talk to the actual people in industry that are dealing with the crises, dealing with the supply chain, dealing with shipping from China, dealing with shortages of labor, dealing with price increases from suppliers, and how they're going to handle that. And so, my answer to your question is precarious. It's a very dangerous time. We're seeing this play out. A lot of the things that we're seeing are sort of potentially surprising and unique manifestations of the underlying phenomenon, but they had to express themselves in some way. And so when we look at what's happened in Kazakhstan, or we look at what's happening as we speak up north in Canada with the trucker revolt over the vaccine mandate, those are all sort of relief valves, pressure releases of an economy and a supply chain and a stock market that we think is at a very precarious potential tipping point. And it's called Doomberg for a reason. So nobody comes to Doomberg for the glossy, optimistic, everything is going to be great read. We are optimistic people broadly in our lives, but we do have the sense that something is very wrong in the economy. The things that are wrong with the economy have to eventually manifest themselves in the stock market. And so, yeah, precarious is my answer to your question. And we are watchful, but it's a pretty scary time.
All right. Well, with that type of outlook, your worries about, fitting in with our past parade of guests on this program should go away, because you're in very good company there with those concerns. I want to talk to you in some depth about the importance of natural resources, especially oil and natural gas. But before we get there, let's try to round out the financial side first. So think of this as almost sort of a bit of a lightning round here. But totally understand you're choosing the word precarious to describe where we are right now. It sounds like you think the economy is undergoing a number of different stresses, has maybe some very just sort of fundamental, unsustainable elements to it. And if I understood your answer correctly there. You don't think that's really been reflected in the stock market yet. So I'm going to assume you think the stock market is probably due for some sort of corrective event at some point in the future here. You mentioned inflation. You mentioned that one of the key advantages that you guys at Doomberg have is that you're talking to the executives who are actually making the decision, in industry. So you're as close to the pulse as one can get in terms of what's actually happening out there and the people who are actually making the decisions. Do you expect inflation to continue to persist from here? And if you do you expect it to worsen or moderate as we get through 2022?
So it's a difficult question to ask. I would say from the time we started writing, the inflation deflation debate has been settled. And I think that the deflationists or the anti-inflation camp would have been surprised to see CPI prints north of 7, and natural gas in Europe peaking out at $60 per million BTU, which has to manifest itself down the supply chain in ways that we've written about several times. The question of where we go from here is an interesting one. So one of the key points that we've made, and literally the second piece we ever wrote made this point, is that this is the first inflationary pulse that is occurring at a time when we have hyper interconnectivity on social media. And inflation expectations are a key driver of inflation, at least historically. And one of the points we've made from the beginning of Doomberg is those inflation expectations can be manipulated. The social media algorithms, they're designed to get you to be anxious, to be angry, that's what drives engagement. But most worryingly for us is that many of the social media properties that can affect our expectations are controlled by foreign actors who don't like us. Think TikTok. This is an uncontrolled experiment that we're doing, which is we are having an inflationary pulse at a time where inflation expectations can be manipulated by people who don't like us. And it remains to be seen whether, as we like to say, and we wrote in I think it was the second piece we ever wrote, when the first picture of a $20 Big Mac goes viral on TikTok, how does that manifest itself in a reshaping of inflation expectations? Who gets to decide what goes viral on TikTok? It's certainly not us. And then our hypothesis is that the Fed and the U.S. government generally is totally ill-equipped to even understand the phenomenon in real time. And so I would say based on the supply chain issues that we see from our contacts, they don't seem to be resolving anytime soon. We just see, companies like Ford reiterating that 2022 is going to be a terrible year because of a chip shortage. Chip shortage has been around for many, many, many months and doesn't seem to be getting better. But on the flip side, of course, eventually things get so bad, oil gets so expensive, energy gets so expensive that you end up triggering a sort of a deflationary sort of air pocket because of economic activity slowing. And so the whole game is to try to predict at what level will inflation and or supply chain issues trigger a collapse in GDP and a recession. But neither of those outcomes we think are particularly bullish for the stock market, at least in nominal terms. And so it remains to be seen. But it is as we said earlier, we think it's a pretty precarious time. There eventually will be a rebirth and a relaunch. And at that time, you want to be very, very bullish because we are bullish on the human spirit. But it is, I would say that the German PPI print of what I think 24.2% that came out a couple of weeks ago, those are real big numbers, much higher numbers than we can imagine. And as many have pointed out on Twitter, the last time we had a CPI print north of 7, I think the Fed rate was 11%. And so here we are debating how many quarter point increases will happen over the next 12 months with the CPI print already hit north of 7. These are truly uncharted territories.
All right. And I want to get to the Fed in just a second here. So a couple of things. One, near the end of this conversation, we'll talk about, the world where you really want to be bullish again. And I'm curious if you're going to change your brand to Doomberg at that point in time. But bad joke, I know. But where I'm trying to get with inflation here is hopefully at some point it will start to moderate. Some of these supply chain issues will eventually make their way through, whether the Fed starts hiking or not, but let's assume that it does. Hopefully that begins to have some effect or whatnot. But even if it does, is this sort of a pig through the python moment where, or situation where we're just going to have a good chunk of inflation for a lot longer than we want because, of what's already happened today, right? You just talked about that German PPI increase. It's hard to get that out of the system quickly, right?
Yeah, one of the things that, they say in life that your strength is your weakness. Our strength is we have very good pattern recognition and we can be early to see things. That's also our weakness. And so, for example, we were very early to call the fertilizer crisis. And a pretty strident piece we wrote all the way back in October called Starvation Diet. We very quickly connected the dots between European natural gas crisis leading to a slippage over into China, which led China to halt exports of phosphates to the US. And fertilizer is nothing more than basically, natural gas plus phosphate.
Right.
And so, but it takes time for that stuff to roll through. And so when we were at an agricultural conference a couple of weeks ago, and dozens of very large farming operations were represented. And the talk of the whole conference, some 4 months later, was fertilizer prices, how they were going to respond vis-a-vis planting, whether they would use more manure and accept lower crop yields in lieu of paying 2 or 3 times the cost of fertilizer that they had historically paid. And it's pretty simple to say that food prices have to go up. There's going to be less food, and the price of that food has to go up. But it's one thing to say it 4 months ago. It's another thing to wait 8 months for it to be realized. And so I would say that this push-pull of inflationary pressure vis-a-vis ability to grow the GDP in real terms is real. But the markets we're looking at very closely are food, vis-a-vis fertilizer. And then the consequence of that, of course, historically, is anytime we have massive food inflation, especially in the emerging economies, then you see geopolitical risk crop up, and ultimately you see war.
Exactly.
So, yeah.
Food and energy prices go up too much, and you get the Arab Spring. You just get it everywhere.
Yeah, and that energy is life is one of the key themes and one of the phrases we've tried to inject into the sort of financial cultural vernacular, so that people can understand that when we tinker with energy, we ultimately tinker with life, and when you tinker with life, people respond, and we're seeing that in Canada, or we saw that in Kazakhstan. On the path from abundance to starvation is riot. And people will riot on the path to starvation. That when you have nothing left to lose, you make the ultimate YOLO bet, as my friend who writes Bagholder quotes would characterize it. So.
Okay, yeah, yes, and I actually have questions coming up here on my list to dig more deeply into this, because this goes back sort of into my background before starting Wealthion. So very much am with you there. And yeah, when you can't basically feed your family and keep them warm, you've got no other choice than to basically revolt up against whoever's in charge, because whatever they're doing isn't working for you. All right, I want to move on to the Fed, but real quickly, you mentioned something I thought was just really interesting, which was our hyper-connected world now over social media. I kind of liken it to the difference between the Spanish influenza back in 1918, 1919 and COVID now, where the earlier pandemic, yes, it crossed the world, but it took longer because it took people longer to move places. You had to take a ship, basically, or hop on a train. Now that you can take an international flight and be in a completely new continent in just a matter of hours, and it's so much cheaper on a relative basis than it was 100 years ago to travel, that pandemics are much more dangerous now, because the number of human contacts is multiplied dramatically because of that ease of travel. It sort of sounds like you're saying there's something similar there in social media, where to develop the inflation mindset, people have to start getting worried that prices are going to go even higher tomorrow. And in the past, the signals that sent them that information came on a daily or weekly basis. You're reading the paper, you're listening to the news on TV or the radio, back in the older days. But nowadays, you get social media updates, multiple times an hour, maybe even multiple times, a minute if you're a power user. And so the ability of the herd to get spooked can happen in such a faster time frame now. So am I getting the analogy right here?
Yeah, let me do the sort of classic communications training technique of a yes and. So yes, I agree. And the thing we're mostly concerned about is the fact that this need not be random and can be programmed by people who don't like us.
Right. So not only is the frequency higher,
Correct.
but the actual content we're getting can be manipulated by other players.
So if you just take a step back, we all know you're a Twitter user. I love following your account. We're obviously very big on Twitter as well. The Twitter algorithm routinely tries to, and I personally manage the Twitter account for the Doomberg team, it routinely tries to make me angry. And sometimes I let it, much to my chagrin. And because it's constantly putting things in front of you, when you hit refresh, that thing that you see in front of you is not an accident. The entire most sort of pertinent criticism of social media companies like Facebook and Twitter and so on is that they have discovered that anger leads to engagement, and they're in the engagement business. Ergo, they are in the anger business. So
right. And sorry to interrupt you, but anybody who saw The Social Dilemma on Netflix probably has a good sense of what you're talking about.
Yep. Exactly. But also anybody who is routinely interacting with social media would also have a sense of their own visceral experience of that phenomenon, which is, and I keep literally one of the things we try really hard to do is not to get fully sucked into it. And it's hard. And it takes discipline and conscious knowledge of what the algorithm is trying to do, and a certain mantra in your head that, thou shalt not engage with trolls, and so on and so on. Now imagine that algorithm is not only optimized to sort of anger you, but also to scare you and to put in front of you the most extreme examples of inflation, because a foreign actor has decided that it's in their interest that the US population lose faith in its currency. For example, it's not like currency isn't a weapon in geopolitics. It's not like we haven't threatened to use the SWIFT system, for example, as retribution for the Russia-Ukraine situation. There are foreign actors who have control, influence over social media that American youth and American adults are consuming. And we have mindlessly delegated a whole series of our expectations to potential foreign bad actors who have nefarious intent. And our inflation expectations are just one of several potential sort of internal psychological behavior states that we have delegated to people who have ill intent towards us. And the thing that scares us the most about it is we don't even recognize it yet as a problem. We don't even admit that this is actually an issue, let alone have we thought about intelligently intervening. If you look at what China is doing with its internet and its tech companies and social media, they see the problem. And having traveled to China 4 times a year for the better part of a decade, when you go to China, Twitter and Facebook don't work. They are not allowing foreign social media to influence their people. The social media that influences their people is under the firm grip of the Communist Party of China. And I know from experience that when you get on the plane, literally as you leave the Chinese airspace, suddenly you can go back and check Twitter again. You can be on the Delta jet from Shanghai to Atlanta. You're not going to be able to check Twitter or Facebook until you leave Chinese airspace. It's that regimented. It's that controlled. We have no such thing. Now, that's great. We'd love to live in a free society. And so I don't know what the answer is. I just know what the problem could be. And it's something that we think about a lot.
Yeah, it's very much an underappreciated vulnerability, I would say, in the minds of most people who aren't watching it nearly as closely as you. Just to put a little finer point on this, it's this sort of spooking of the herd or influencing the way that the population feels, particularly around things like inflation. It's called sort of stoking animal spirits. And we're talking about social media. It makes it a lot easier to inflame those animal spirits. And then the nefarious side of it you're talking about is almost like an actor giving those animal spirits rabies. Right? Yeah. And it's this whole other risk that previous generations didn't have. And as you said, we don't even really necessarily as a society we're not really awake to it yet as a potential problem here. So really interesting point of view to flag for us. All right, I got a long list, so I'm going to try to continue to hack through it here. We talk about inflation, the Fed. You gave a little bit of nod to, I think, a sense that, hey, what the Fed is planning on doing here, it may not really be, it may be more signal than actual substance. With 7+% inflation right now, a couple quarter point hikes, are they really going to make enough of a difference? What do you? There's a lot of folks that think the Fed has painted itself into a corner here. Do you agree? And then whether you do or you don't, how effectual do you think the Fed's going to be in combating inflation in a way that that doesn't spark a larger problem throughout the rest of this year?
So I think, I should say as a disclaimer, we feel far more comfortable expressing our thoughts and beliefs in the energy supply chain side than we do, say, observing the Fed. There are lots of people who are more experienced in this matter, but we're always happy to articulate our opinion based on what we read from others and our own thoughts. But this is one area where we're more sort of speculating than we are sort of describing some expertise that we have with decades of experience. Having said that, as a disclaimer, we do think the Fed is cornered. And the thing that bothers us the most is, to be fair, during the Trump administration, the Fed became very politicized. When Jerome Powell decided not to stand up to Trump's persistent interference in the Fed's decision-making process and demanding that the Fed, quote unquote, do something because Trump viewed the stock market as his personal scorecard as president of the United States. We believe at that time, Jerome Powell should have resigned. When the president of the United States takes to Twitter and ridicules you and berates you and tries to influence overtly the decision-making of the Federal Reserve, if the Federal Reserve was truly independent, then the chair of the Federal Reserve would have sent a very strong message to global actors that the Fed is truly independent. And if Powell had resigned, that would have created a sufficient crisis amongst the Trump administration to perhaps prevent the situation we're in now, which is the full politicization of the Fed. So
sorry to interrupt, but Powell's pivot in 2019, correct, is only adding, support to your point there.
Yes. So if the Fed is not independent, then the Fed is just another political animal. The Fed is just another equally powerful version of the Supreme Court. It's another political battleground. So what we see right now, even with the Powell renomination, we see the MMTers trying hard to torpedo his nomination because of the insider trading scandal, which we do agree is outrageous. But ultimately, once you cross that Rubicon of losing Fed independence, then it's literally nothing more than we're going to, break the filibuster rule in the Senate on Supreme Court nominations. It is a hyper-political organization today. Jerome Powell is a political animal. Joe Biden is under the gun vis-a-vis midterm elections coming up. And I think there's a real undercurrent of danger if the global economy views the Fed as nothing more than just another political arm of a relatively politically, dysfunctional U.S. system, then that's really uncharted territory, especially when you mix in the fact that we're at 7% CPI, which everybody kind of probably agrees is an underestimation of real inflation, with 0% interest rate and still QE ongoing. And, all the talk of tapering, the Fed balance sheet still continues to grow. So, it's a truly, when you think back to, Volcker and the 1980s and the slaying of inflation, that can't happen in today's environment. Jerome Powell cannot, nobody with any sort of realistic view of what's going on can say that Chairman Powell has the power to stare down an administration in the bunker already for a variety of political reasons and do what's necessary to restore faith in the US dollar, to slay inflation, and to give confidence back to the bond market. So ultimately, we're just in this very interesting, uncharted, I think, very historic time where we're running an experiment, and we'll have to see what the results will be.
All right. And you mentioned the Fed is now highly politicized and it's getting a lot of pressure from Biden, who's looking at he's looking at his sinking approval numbers, but he's also looking at the November elections. And I'm sure there's a ton of pressure saying, look, inflation's the kind of thing that votes people out of office. So Powell, get it under control here. I don't do political analysis. It's not my forte here, and I'm not necessarily expecting you to be a political expert here too, but I'm just curious, what, if anything, do you think Powell can do that could make a difference in time for the November elections to actually be helpful to the incumbents? Because Fed policy takes a while to really, get reflected in the real world. And, just jamming up interest rates, even if Powell really wanted to try to be a Volcker and just be really serious here, immediately the stock market's going to tank, and that's not going to help anybody get reelected either. So is there really much the Fed can do to help in time for November?
I don't think so. And that's why when people say they're trapped, I think that's what they're trying to articulate. And I do, again, go back to the original hyper-politicization of the Fed. And look, we're sort of bipartisan here. We see issues on both sides. I do think that it was truly a remarkable thing what Trump did to Powell, and the fact that Powell acquiesced. And the time to have crashed the stock market was back then. And by punting on it, it only makes the problem worse, and it only makes the resolution of it more difficult. And so then you kind of get this do loop of printing to save the stock market, valuations going crazy, which requires more printing, which causes valuations to get more crazy. I mean, nobody would argue, well, some would argue, but only the most political partisans would argue that the stock market valuations today somehow feel justified based on present value of future earnings and dividends and terminal value of the companies that are being bought and sold. There's a speculative mania. It's starting to sort of come off a little bit from the tops here in the last couple of months. But if the Fed doesn't like where the stock market's going and takes the pedal off of the tightening, what happens? And so to the extent that the Biden team is unwilling or unable to bite the bullet to do what's necessary for the long-term flourishing of the U.S. economy and the U.S. population in general, then I'm afraid that it's just going to be more of the same. And so we will see another pivot, perhaps, just in time for a relief rally heading into the midterms, which is what Team Biden would desperately want, and who could blame them? I mean, again, they weren't exactly handed the best deck of cards to deal with, and so one feels a little bit of sympathy for the people in the arena. And we're just sort of speculators and observers of the arena. But there are very few sort of fantastic, obviously logical options available to both the chair of the Federal Reserve and the president. And we would argue that this is just the latest manifestation of a series of bad decisions over the decades of not willing to take the medicine when we should have. And I would argue that the last Fed chair to actually feed the American people the medicine they needed was Volcker.
And I think a lot of our viewers would agree with you there as well. All right, so when people talk about the Fed being stuck in a trap too, I mean they are also talking at a higher level of they've got especially now with inflation being out of the genie being out of the bottle here, is it's increasingly this sort of sense of either protect the markets or protect the economy. And they would be the thing that would help them out the most and would help the administration out the most, whoever's in office, Republican, Democrat, et cetera, is a return to robust economic growth. But that does not look like it's going to happen anytime soon. And we're already seeing, the growth that we did, the spurt in growth that we did get from all of the trillions and trillions of stimulus that were shoved into the system after the pandemic hit. We're already seeing a marked deceleration. We saw, an actual Q4 2021 GDP growth print of 6.5%, which is a tremendous number. It's heavily padded by a lot of inventory restocking, which is sort of a one-time event. But now looking at Atlanta Fed's GDP Now numbers, it was as low as 0.1% until a few days ago. I think it's now risen to maybe 0.7, but that is a marked deceleration. And we just launched a video today on Wealthion where Lacey Hunt was sort of walking through, all of his deflationary, macro evidence that says, look, we're now at a point in the system where we're adding so much debt that just really any more government spending, any more stimulus that goes in the system, actually is making things worse going on. Then you add in, inflation, decreasing profit margins, and if the Fed starts raising interest rates, that makes the cost of capital more expensive, and again, that hurts companies. So that, there's an awful lot of things that are making economic growth looking like it's going to be harder and harder to come by going forward. What do you see through the lens you look through, because you're talking to the guys that are out there in the trenches trying to build economic value?
So now I'm going to give you an optimistic look, and the things that we think would be required in order to have that optimistic look come to fruition. We wrote a piece in early October, so long before many of our current subscribers would have read it, called Opposite George, where we decided to hey, let's look through the crisis and consider what the rebirth might look like. And there's only one real thing that needs to change. So the thing that needs to change is we need to have the Wall Street expectations game be recast. So one of the contributors to the problem that we find ourselves in is this ongoing quarterly pressure and the management incentives tied to that quarterly pressure that cause American companies, Western companies, European companies to continuously trade off robustness for quote unquote efficiency. And what we think is going to happen as a consequence of the crisis that is ongoing right now is we're going to see a wave of reshoring. And GDP is nothing more than the measure of economic activity, and it's going to create an enormous amount of activity to do this correctly, if we have the political will and the financial fortitude to do it. And we're going to drop a piece in a couple of days here about rare earth metals and the US's fledgling attempt to wean itself off of the Chinese monopoly of those. This is going to be a trend that we're going to see play out. We think that once we get through this crisis, there's going to be a wave of, onshoring of critical supply chains, understanding that quarterly efficiency is not a sacrifice worth making, and that robustness should be included in our NPV calculations and our calculations of value, that just-in-time inventory management is susceptible to the types of dislocations that we've experienced in the past 2 years, and that just in case is worth doing. And that if the thing that needs to change, we believe the most, is that Wall Street analysts and stock market analysts and investors need to value a company that is more robust, not just more efficient. And that having the ability to withstand a supply chain crisis because the port workers went on strike or a key supplier may have shut down, that's going to come at a lot of cost, i.e. economic activity. And GDP measures economic activity. And we think, the piece was titled Opposite George because it's atypical for us. It was trying to be optimistic, looking through the crisis to see what's going to happen on the other side. And that's, to us, when we start to see that, and one never knows when to call the bottoms, but when the next crisis comes, a proactive political leader that can allow both the citizenry and the investors to understand that the value of robustness is not zero, but in fact is very high. That could be the seed, which becomes the flower, which becomes the forest, for a rebirth of the U.S. economy and the next leg up in economic growth once we get through this cycle.
Oh, well, that's great to hear. And look, a couple of things. One, Luke Roman is beating a very similar drum about the U.S. basically being at a key decision point where it needs to actually make that decision, or just, let the U.S. manufacturing industry die entirely. And of course, he's like-minded as you are, and I am as well, which is that the value of resilience is a value worth paying, right? And as you said earlier, we past 2 years have been a case study in the fragility of the just-in-time system. It produces things very efficiently and very cheaply, but it's brittle, and when it breaks, the cost of the breakage can be oftentimes way more than the savings of the efficiencies over time. And what that will do is it will mean that things will cost more in general, in terms of their sticker price, but the value that we're getting for that and the protection against a lot of the, supply chain crises and stuff like that we're having right now, as well as, the huge job losses we've had through offshoring and everything like that. There's an awful lot of long-term benefits that come from there. But but it requires a lot of belt tightening, and a lot of near-term
Well,
sacrifice, and we haven't had the political will or muscle for that
it
recently.
requires one really important thing, which we're happy to articulate for you and your audience now.
Please do.
It requires a reorientation of how the managerial class is compensated. And it's very simple once you sort of see it. The managerial class is compensated by and large by options. And when you're along options that have been given to you, the thing you really need is volatility, because Black-Scholes equation of the valuation of an option, volatility is a key input into it. And so if you're in the managerial class and you are compensated vis-a-vis options, you don't care actually what the stock price does. You just need it to have volatility. Because in the years where the stock is very low, you get the next tranche of options priced at a very low strike. And then in the years where the price of your stock is very high, you get to cash out on those. And sure, your new option tranche is priced at perhaps an unrealistic target. But if you just have a volatile stock, then that's all that really matters. And so there is and Ben Hunt, to be fully transparent, has been banging this drum for a long time at Epsilon Theory. The managerial class is compensated by volatility today, and that needs to change. And if we can reorient the compensation structure of the managerial class and have Wall Street and Western-based investors recognize that long-term value creation is the single most important thing, that the terminal value of your company matters, and that it's not just a greater fool's trade, a negative sum greater fool's trade where we're trying to steal from our neighbors and take bricks from the bottom to put it on top, then we will begin to see the seeds of the type of GDP growth and sustainable economy that many of your listeners yearn for. We do think it's very, very critical. And by the way, this can be done. Like if we can have, Larry Fink dictate ESG mandates to companies, it's not that big of a stretch to assume that the Larry Finks of the world could also dictate compensation strategies for these companies, such that we totally reorient from, quarterly missing your earnings by 1 penny causes the stock to go down 12 or 15%. That drives very, very perverse incentives for the people that are actually pulling the levers in the economy, which is the managerial class of the companies that we all invest in. And so to us, that's a key sign point when we can begin to see the universal acknowledgement that the compensation structure of the managerial class has failed us. And we can replace it with something that is more oriented towards sustainable long-term value creation and robustness, then we have a win.
Yeah, I'm right there with you. And I think the big question here is this a reform that we're going to put in place proactively because we think it's the right thing to do, or is it going to be reactively where the system we have just becomes so painful to continue that we're forced to adopt something better like this? And time will tell. In fact, I think this is a whole other interview that we could have. I'd love to continue picking your brain on it. One thing I'll just quickly mention is it's hard to have this discussion without addressing buybacks as well, right? Because you talk about how we have these perverse incentives, really, at the end of the day, to get compensation up in the short, or get stock price performance up in the short term, because that's how everybody's in the managerial class is compensated. And so you end up with all sorts of accounting gimmicks. But certainly what's been driving, I think, as the estimates I've seen, is like almost half or more of stock price valuation over the past decade has been stock buybacks, oftentimes which are at the cost of borrowing debt to then buy the stock back, where you're basically hollowing out the enterprise itself. So, it's almost kind of the exact opposite of the reform you're looking for here. It's going to be really interesting just to see what's going to be the trigger that lets us step back and take that, fresh-eyed view of this and say, you know what, we're going to just totally restructure this.
Well, let me be very clear, because I want to drive this point home. I was an executive for couple decades. The team at Doomberg is composed of similar people. The most lucrative year for me personally, vis-a-vis net accretive wealth creation for me and my family, was from the slate of options that I received during the global financial crisis. Because our stock was at a ridiculously low level, and these option grants are granted in dollar terms using a Black-Scholes valuation, using the strike price of the stock at the time that they're granted. And so perversely, as I said before, the volatility of your stock is all you really need if you're getting a fresh slate of options every year, and all these executives are. And the solution is, if you look at ESG, all we need to solve this problem is a reorientation of emphasis towards G in ESG. ESG today is essentially E.
All right. And sorry, Doomberg, but if you can just explain what the ES and G are for folks that don't know.
Yes. Environment, society, and governance. So ESG, environmental, social, and governance. Those are the three sort of pillars of ESG. And today, there's a bastardization of that term to basically mean, am I adding to or helping to solve global warming? i.e., it's all E. And the governance part of ESG is radically overlooked. And we believe that is the key, that the allocators who have all the power today to turn the knobs on E could focus some of their attention to G, good governance, compensating your managerial. Like, what is governance? The governance is the system of ethical belief and framework through which your company operates. And ESG is way more E than G today. And we believe post the next crisis, a re-emphasis around G is a key part of the solution. It's available today. If Larry Fink's next CEO letter focused on G, we would see a difference.
All right. And, you say after the next crisis, I'm going to try to be optimistic, but, my long study of human nature shows it probably will take that next crisis to get people to really focus heavily on this. It will be interesting too, because you got, everybody kind of in positions of power at all these firms benefiting from the current system. How willing are they going to be to, defer parts of their compensation? And maybe it'll be great. I'm not trying to rain on the parade at all. I want this reform to happen. But anyways, I think that's going to be a fascinating and longer interview that I'll have you back on to really delve into. I still have a ton more questions here. I'm not going to get through all of them, but there are a couple of topics that I just would be remiss not to get to with you here. And the big one here is the interdependency between energy and the economy. And from my old prior days at Peak Prosperity, we used to talk about this an awful lot. And I was always just continually shocked by how many people treat the economy and our energy systems as two separate systems, not realizing that you just you can't do anything in the economy without the energy system. They're completely interdependent. In fact, if you map energy consumption and GDP, it's basically like a 0.99 correlation coefficient. I mean, it's about as tight as you can get. So I guess my question for you first is do you share this sort of same, being flummoxed that more people don't see this connection? And why don't you think they get it?
So this is the literal market inefficiency that Doomberg hopes to occupy.
Our interview with Doomberg continues over in part 2, which will be released tomorrow as soon as we're through editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as that little bell icon right next to it. And be sure to click the like button too while you're at it. While you wait for part 2 of this video to come out, I can't recommend highly enough that you head over to doomberg.substack.com and sign up for the truly excellent free newsletter that Doomberg publishes. It's some of the absolute best macro analysis available on the web today. And last, if this discussion about the growing instability of our economic, financial, and social systems has you feeling a little vulnerable, then consider scheduling a free, no-strings-attached portfolio review by a financial advisor who can help manage your portfolio, keeping in mind the risks and opportunities that Doomberg has highlighted here. Just go to wealthion.com and we'll set one up for you. Okay, I'll see you next in part 2 of our video interview with the Doomberg Chicken.